smart beta ETFs across the world are about 14 to 15% of the total ETF AUM. So that's about, out of the total 5 trillion, we're talking 14% contribution from smart products, or basically 2.0 products. These have been growing, apparently, as the numbers tell me, at a rate of about 30 to 33% CAGR over the last several years. This is, again, global data that I'm talking about. Where are we in India? Kind of non-existent, to say the least, because out of the total AUM that ETFs as products have in this country, about 95,000 crores, or let's round that off, 1 lakh crores. Out of the total AUM pie of 25 lakh crores, that's of course still minuscule. And if you're talking smart beta products that are using some of these strategies that we just heard of earlier, then that number, I'm told, is as little as about 1,500 crores to maybe just 2,000 crores. So obviously there's a vast journey ahead that sort of lies before us. The question is, how do we get the ball rolling? So without taking any more time, let me quickly get some opening thoughts from our panelists. And Navneet, I'm going to start with you, because interestingly, I think SBI has just been out in the market to launch one of these ETF products. Just tell us your overarching thought process and philosophy, because you're as active in terms of active management, and you're also here talking about smart beta ETFs. So opening remarks.
Sure. So, of course, my colleague Matthew explained the concept of smart beta, but maybe just for the benefit of the Indian audience, let's take a step back. And this is known as systematic beta, alt beta, smart beta, various names. So you have at the two ends of the spectrum, active and passive. Passive, mostly you have market cap based indices. So let's say if you have Nifty, where you have 10% SDFC Bank, 9% Reliance, 8% SDFC Limited, whatever, 6% Infosys, and so on and so forth. And on the active side, what the fund manager is trying to do is, he may have an information edge, analytical edge, behavioral edge, and buying stocks which are differently weighted than this index and trying to generate that alpha. Now, that alpha can be broken into two parts. One is a skill, I said, as he may have edge, but a part of it, alpha, is also the factor exposure. So when a fund manager says that I do better than the market because I buy quality stock, or I'm a value investor, or I'm a growth investor, or I'm a momentum investor, he's using a certain strategy, and that strategy can be commoditized, or can be created as an index, and that index can be provided. So for example, we are in the market with this quality index. So if you see the same Nifty 50 or Nifty 100 or Nifty 200 stocks, where let's say instead of weighting them in line with the free float market cap, you can do that with quality, which is explained as maybe a return on equity, earnings, stability, or the lower debt to equity. You can do that based on dividend yield. You can do that based on revenues. You can do that based on a certain risk parameter, volatility of each of those stocks, the risk of those stocks. Variety of ways you can weight these stocks. And I think there's a long way to go, because as the previous panel also discussed, that if the alpha comes down and there is a way that a similar alpha exposure can be provided in a passive format and a more easier format, we have a long way to go, and we believe very strongly. So this is like an active fund in a passive format, and I think it has a long way to go. And of course, even in the fixed income side, we can discuss that later.
So we're basically talking about a fund that becomes almost as smart as you, or Vetri, or Sampath, or Lakshmi. Not quite as smart, but almost as smart.
Also, the differentiation. So let's say when you look at Nifty, or you look at the Nifty quality, because it's based on free float market cap, you have a large weight in the financials. The top 4 stocks in the top 10 in Nifty are like 26%, SDFC Limited, SDFC, ICICI Bank, and Kotak Bank. Now you create, from a diversification perspective or from a risk perspective, if you weight them as per some other parameter, which I mentioned, ROE, earnings variability, and the debt to equity, you will have an index which doesn't have financials. So it's not only about a better return, but better risk-adjusted return, because you get a huge diversification benefit.
Okay, Vetri, let's get your initial thoughts in as well. And also from the indices point of view, I have the entire NSE list of indices here. From the Alpha 50 to Alpha low volatility, Alpha quality low volatility. You have multiple indices which are strategy-based indices. So the indices are there. The takeoff in the market in terms of products has been fairly slow. Your initial thoughts?
I think it goes back to what was discussed on the previous panel, which is to say that in the first place, there is a structural issue in terms of how people can actually invest in ETFs related to the broking account and all those issues. B, it's related to the fact that we've just about reached the point where people are starting to get comfortable with the idea of investing in mutual funds. They're still investing in funds, not because they want to achieve their financial goals, but because they've been sold the idea of market-beating returns. And therefore, the idea of market equivalent returns sounds like the average choice that you wouldn't want. So I think when you look at it in that sort of context, one of the challenges we need to keep in mind when we think about smart beta is what I call the ice cream conundrum, right? Which is, if you look at it, the most popular choices of ice cream are typically either plain vanilla, which you could call boring, or chocolate. That's sort of the global statistic, right? And in India, people haven't bought enough of the chocolate or the vanilla plain, right? And you already want to sell them Belgian fudge chocolate chip, right? Cookie fudge or cookie dough. So I think that's the challenge. We first need to get people accustomed to the idea of the basic product. And then India is a strange country, right? We have a case where in the last 3 or 4 years, we've had this massive move towards financial inclusion, opening accounts. And then there are people in this room who most probably have never entered a bank in the last 2-3 years because they're doing everything off the internet. So I think the products will coexist, but maybe the scaling will be different.
So here's the thing. The interesting catch is that in this particular example, the Belgian fudge cookie chocolate ends up being actually cheaper than the plain vanilla or the plain chocolate. And the cost factor, and we'll discuss that a little later, I guess that's something that really drives this debate forward, that, should there be place for both kinds of products in anyone's portfolio? But Sampath, let me come to you, and you represent the life insurance industry on this panel. How do you view passive products in the market right now, and this whole conversation of maybe at least slightly moving towards smarter beta products?
I think, from a regulatory perspective, we can invest in the ETFs of the mutual fund companies. That is up to about 5 to 7%. But to come out with our own ETF, probably ETF may not be feasible from the current regulations point of view. But conceptually speaking, we can do smart beta funds. We at the moment we currently run active equity funds and active fixed income funds, and also we give the passive. Right now we are also having a passive equity fund which is tracking the Nifty index. But it may not be in the form of ETF, but certainly we can come out with a smart beta structure, smart beta investing styles. I think there is some merit in certainly the smart beta funds. I think the way it's going, it's becoming tougher and tougher to beat the index. If you look at last 1 to 2 years, most funds are struggling to beat the the benchmarks. Given that, even though actually I believe that the fund management, principle-wise, I believe that active fund will always be there, and that will be the predominant way of managing funds globally and as well as India. But there's a large amount of the passive styles or smart beta styles can also coexist, in sort of a piggybacking the, sort of existing, the large equity market which is there.
Okay. Lakshmi, your thoughts? Because when it comes to fixed income, anyway, I don't know if there are too many ETF products anyhow. I think very few ETF products that are there in the market. So what role do passives really have here? Because from an investor's point of view, anyway, investing in fixed income funds can be fairly confusing. So shouldn't ETFs be, and smart beta ETFs maybe be an easier entry and access point?
So firstly, ETFs are like, the Robo 2.0 version that we saw. We saw a movie release on Friday, and it's just 2 days. I've not seen today's or yesterday's collection, but in 2 days, the Robo 2.0 movie could not gross up collections equivalent to Bahubali on the first day. What I'm trying to tell you is that the Bahubali is the actively managed funds, whether it's fixed income or equities, and then the add-ons, whether it's Belgium chocolate chip kind of a thing. It's not good to talk about lunch right now so much because people are already hungry, but movies at least can keep them activated. So I think so long as the Bahubalis are still, putting their might across and they, release in various languages, ETFs to that extent will continue to be subservient from an overall mutual fund industry standpoint. And you read out the numbers, $5 trillion ETF industry. We're talking about $300 billion mutual fund industry. And within that, a $12 billion equity or, largely ETF industry. It is therefore this number that tells you that In India, when it comes to investing, fixed income are second fiddle players typically, because the first love and the first port of call, right from crush to flirting to one night stands to marriage, is with bank fixed deposits. And in that, you push them further and say, don't buy gilt funds or don't buy bond funds, buy ETFs. That is, lading a Belgium chip waffle with some, crispies and, kind of making the glass a little bit crusty. That's like too much to ask. So my sense is that, you have to, make the baby walk and then put him onto a pram and then take him to the next level and see him grow. And I think that's where retail investment with respect to ETFs, specifically if you say on the fixed income side, is. We have a gilt industry in India which is spanning across 2 decades. And I don't know if it's a matter of pride to say that sitting here, Kotak Mutual Fund launched its gilt fund first time in India, but that's the only thing to it, because the gilt industry is just about $1 billion plus, give or take a few thousand crores. So the point I'm trying to make is that yes, you have to first inculcate the habit of investing. So yes, that's warmed up reasonably well into equities. Then you go to the next leg and tell people that, okay, now there is fixed income, and within fixed income, there is a possibility of looking at ETFs. But my sense is that much before that, we need to see a cult of ETF per se. And ETF right now, at least in India, is reasonably synonymous with equities. So we would want to see that happen first. Hopefully, the new proposed launch of the debt ETF in India could be a small awakening to that cause, but we're still at the tip of the iceberg.
And Navneet, here's the thing. So where are the challenges? Because the existing products that are there in the market, they usually sort of follow one factor, whether it's the equal weight concept. We have a couple of those products. We have the quality that you've launched. There are a couple of products based on the value index, which is there, the Nifty Value 20. But the size of most of these ETFs is pretty small. Where is the roadblock? Is the messaging not going? Is it just because of the fact that these are ETFs, so therefore the uptake from the retail community is not much? Where are the big roadblocks?
No, so as Vechi mentioned earlier, that despite all the efforts, still the plain vanilla itself is like very small. So just 1.8 crore investors after, right from 1964 to now. So we have a long way to go. But I think the good part is that the innovation has begun. You are seeing some of these products, and over a period of time, you will see several of these factors as investors become more mature. Those who have got enough of that vanilla and the chocolate, maybe they would look for some of the other exposures, and then people start looking from a portfolio perspective. As of now, you're looking at what has worked, and that's why you are overweight there. But over a period of time, different cycles, you need to look at the risk-adjusted return. So maybe let's say there is a factor which doesn't do well in a particular economic cycle, but it works in another economic cycle. You have to look at the risk-adjusted returns. Maybe there could be products which reduce the overall portfolio volatility. In fact, the institutional investors also, as of now, because they've just begun investing in equity, they're only looking at the market cap weighted because there is hardly any equity exposure there. But once they reach a certain size, I'm sure they would look at from a portfolio perspective and would look at different options.
Okay, fair enough.
Maybe there are a variety of things required. Maybe just like a mutual fund sahi hai, maybe within that sahi hai, there is some ETF sahi hai.
Actually,
you need variety of things.
Before I go to ETF, I think there's a point that Kalpen or one of the other panelists also, earlier panelists also made, that maybe index funds could be the stepping stone before you jump directly to ETFs, because in India, the whole issue of demat accounts and, actually buying across the exchange, maybe that concept is still a bit of a barrier. So, Vetri, maybe your thoughts on that, the role of index funds in perhaps bridging the gap between ETFs and actively managed funds.
Yeah, I think, index funds are easily, they don't have a market access problem. It's very easy for people to set up an SIP, go to one provider, automatically it will get debited from your account, the units show up in your statement. So clearly, I think index funds in that sense are a product which can get distributed a lot more easily given the current system. If we can find a way to make the ETF also a simple one-click go-to-buy sort of solution, then perhaps that could also see traction. But as of now, I think the index is, much easier. Just on the other, sort of question that came about the, smart beta point, and I won't labor the point too much. But I think, you will see some take-up for the smart beta products come through, particularly at the top end of the market, where I think people are getting a little bit more sophisticated about the kind of products they want to have in the portfolio. They're also becoming a lot more conscious about the cost that they are paying for the product. So I think you will start to see some take up over there. And one of the interesting ways to distinguish the smart beta products over there, and it fits to, I think some of the themes we saw in the previous presentation, is what it can do for you, which will distinguish itself from the plain vanilla benchmark. And what it can do is, the plain vanilla benchmark, which we have now come to sort of agree is the free float weighted index. I won't say it has a problem, but you could argue that in a sense, it's actually an accentuated momentum play, right? Hold the winners and cut the losers. So the weight of whatever is doing very well is continuously going higher, and the weight of what is doing poorly is continuously going lower. And therefore, smart beta can actually play a very interesting role here to sort of say, are there inflection points, or are there factors using value, or just the need to keep the portfolio equal weighted, the need to keep the portfolio equal weighted across sectors, which can help you sort of navigate inflection points much better. So you could position this not necessarily as something that will create an alpha, but it just flanks your core index strategy, which could have a drawback in the sense that it's very momentum driven because of the way the weightages move. So I think that is something that will find purchase in some segments of the marketplace.
Sampath, we were discussing this earlier offline. Just your thoughts on the way to go passive within the insurance framework and the current regulatory caps that anyway prohibit a life insurance company from parking more than a certain percentage of the corpus in an ETF. So is a change in the regulatory framework something that you would want to see?
No, the regulatory framework is pretty clear right now. We can currently we offer both active as well as passive funds, including even the smart beta strategies as well. The challenge is that, how do we sell and distribute to the customer? Today, we offer right now about 7 different investment styles in our unit-linked funds. 2 of them are the fixed income, and 1 is balance, and the rest is on the equities. When we go and meet the clients, they often ask us, which is the fund to select. That's where the level of understanding of the, investor is. And on top of it, if we offer the, some of the smart beta strategies, they really, find it difficult to sell, and even the distributors also find it very difficult to sell it. But from a regulatory perspective, certainly there's no issue. We can come out with the smart beta strategies, and as well, anyway, passive we are already offering. The Nifty ETF anyway is part of one of our existing offering itself. But certainly, some of the smart beta funds is more useful for sort of a well-educated customers who understand the investment pattern better. It is targeted at mostly those kind of a customer. So let's say if I come out with maybe a quality or a smart beta strategy based on, let's say, growth plus return on equity or return on capital employed, we find it very, very difficult to choose sell this to the customer. Why is quality not there in other portfolio? Something like that customer can simply ask. It's a different thing. And on top of it also, here we do not have some of the smart betas, indices, with a long track record. Most of them are, come up in the recent times. So if if there's a long track record of these, very well established differentiated strategies are there in the benchmark, then it will be a lot easy to sell to the customers. I think that's where we are struggling at the moment.
Lakshmi, your thoughts from the fixed income point of view, whether there is any sort of a regulatory change, or in terms of just the composition of indices, if there's anything more that needs to be done?
I wouldn't say it's a regulatory change required specifically to the fixed income, to be able to enable more fixed income strategies. But I think there is slightly overarching from an ETF standpoint, and we're all talking very sophisticated language, smart beta, etc. I'll tell you, we launched our Nifty ETF in 2008 or 9, or maybe 9. So it's been 10 years. That's about 600 crores because we don't get the EPFO money. We have an NV20, which we launched about 3.5 years back. What is the size differential? It is 1/100th, so my fund is not even $1 million. But mind you, and this is its version of smart beta, right? It's more modified. And that fund has outperformed Nifty. And that's why I keep going back to the Bahubali. So Nifty is the Bahubali year, so people understand. And then, mind you, even the sophisticated investors tell me, get me size. Come on, it's size build size in an ETF industry. So I think the regulatory requirement is more required at the overarching industry level, to enable more ETFs, get more market makers into the fray. So globally what happens is that the exchanges incentivize the market makers, and of course the regulator also tries to induce this culture with the exchanges to be able to enable this. Here there is no such concept called market making, and it's very, very sporadic, and there is a cost associated. And if we are talking about low, so our Nifty ETF is just under 10 basis points, our NV20 is just 5 basis points. Mind you, we have to spend 2 basis points on investor awareness. What do I make? What do I give? Still, that is, as I said, we are all struggling, and we're all, trying to talk about alpha generation is difficult. Here, there is a fund that has consistently outperformed the Nifty, and you're not investing, number one. So, number two is, there is a cutoff limit. So in India, for all mutual funds, the cutoff for transacting is a 3 o'clock NAV. So, you have to make investments or subscriptions and redemptions before 3 o'clock. Now, the exchanges trade till 3:30 in India, and I'm talking about the equity in this case. Now, why is that half an hour allowance not given by the regulator when it comes to ETFs? Now, we have made several representations as an industry body. I think these are these small things. So, as I said, take small baby steps rather than, before thinking of the bigger and the more evolved things. And of course, things like naked shorting, for example, to enable a long short kind of an ETF. Globally, it's very, very prevalent. Or maybe an inverse ETF. So if you want to do an inverse ETF, you need derivatives. Again, we have these whole list of do's and don'ts with respect to derivatives. So I think we need to first make small enablers first. So these, minor irritants, I call them, like why is 3:30 not the legit time for ETFs? That has to, so I'm saying, I think we need to take those steps, and then probably, and the list is already there, and some of them from the regulatory bodies are also present here. We've already given a list of these requirements. That is required, and then the next level we come to in terms of stifling creativity. That is when you will see more takers. Today there are 43 odd mutual funds in India. Not all of them have ETFs, because some of them, quote unquote, tell me, look, it's a waste of time. Of course, we are not in that category. We seeded these funds about a decade back. It does not make money. It's not bread and butter for us. But definitely one day it will become to where cheese is. So I think that's where our limited observation.
Any further remarks to what we've discussed on the panel?
Yeah, so I'm actually going to discuss with my old and dear friend Lakshmi. I think what we don't need is leveraged products. So, I think that talk of inverse products, leverage products, I know globally they've put these leverage products on the ETF platform, but I think in India, I think that's something we should shy away from. It's okay, let's be the first in the world to say we don't want leverage products on the MF platform, be it as an index fund or as an ETF. I think that's completely avoidable. And, we've got other structures like the AF where you can do leverage, so let's keep it there. I wouldn't try and, tackle inverse or leverage structures on the ETF platform. It's a big no-no.
The point is that, I love Pani Puri, but if you like vodka and if somebody offers you vodka-infused Pani Puri, I don't think there should be a problem.
I think this conversation is increasingly moving towards lunch hour. But, we do also have, of course, some of the finest fund managers with us right here on this platform, so I can't not but ask you this. And it kind of ties in. Vetri, let me start with you. Like someone mentioned, a while back that in a certain market phase, maybe in a year when, let's say, 7, stocks did really well on the index, and that was leading the index outperformance. Do those kind of sort of patterns not influence this decision-making as well? Because that's when, if you're in an equal weight strategy, you'd feel like a fool, right? Because you kind of missed out on what really powered the rally. So in terms of behavioral aspects and sort of looking at market cycles, where do these products fit in, Smart Beta?
Surbhi, I think actually, again, you need to rewind back a bit. Again, it goes back to should you have passive in your portfolio at all? And I think, this is a challenge that we are increasingly going to face. When you look at the marketplace, 52% is owned by the promoters, about 20 to 23% owned by foreign institutional investors. All the domestic investors put together will get you to about 90, 91%. 9% is retail. Now, the equity market is not a zero-sum game, but alpha is a zero-sum game, right? Because when you've got smart people going up against each other, my alpha either has to come out of Navneet's share, or it has to come out of Sampath's, or vice versa, or Lakshmi's, right? So it is a zero-sum game. And as we see more and more money go into actively managed strategies, and information arbitrage was a great thing to say 20 years ago when I started my career. I mean, today if you go to Bloomberg, the number of most actively covered stocks are actually Indian stock. right? More people cover than Infosys than they cover, Apple, right? And even as you go down the list, you'll find that so many mid and small cap stocks in India actually have significant coverage, institutional ownership. So I think really the question is, should you have room for passive in your portfolio? And I think as the level of skilled competition in this keeps going up, it's like reaching the semifinals of, Wimbledon or US Open. Federer, great player. Djokovic, great player. Nadal, great player. Murray, great player. But only one can win, right? So I think there is scope for simple beta or dumb beta strategies in people's portfolios, because it will get you to the destination, which is what you as an advisor want your client to get to his destination at very low cost. What's the problem?
If any final thoughts, otherwise I think we're out of time. The clock says 00. Thank you very much. This has been a very insightful and enlightening discussion. Lots of food for thought, I'm sure, definitely for me, and I guess for the audience as well. Thank you very much.